Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admiral Markets. It's Friday, it's the 29th of January, and today we wanna discuss a topic which has probably not yet been a topic in your trading year so far after the first month of trading, a trading losing streak. I hope that you all had a fantastic start into the year and that you profited from the currently especially increasing volatility. So I certainly, I bet that you had the current developments on the agenda in several stocks, which are, by the way, also available to trade at Admiral Markets. It's not that I recommend trading these stocks right now, especially when it comes to GameStop. The ticker symbol here is GME, or a triple BY, for example, two stocks which are in fact available, tradable at Admiral Markets. And by the way, you probably have seen that there are brokers out there currently limiting the access, respectively having restrictions on these ticker symbols. You do not have this issue at Admiral Markets, so there's no limitations, at least where the thing or the topic at my end. So I had the both symbols on my agenda. I could trade them or let's put it that way, I didn't trade them, but I had them on my watch list to look at the action, the current action there. Which is, yeah, certainly something which probably caused some excitement at your end, at least. And still, today we don't want to talk about these hot stocks right now, even though there's certainly plenty of stuff we could talk about here. But we want to focus on a mental aspect on your trading. We want to focus on the topic facing a trading losing streak, which will rather sooner than later certainly happen, because it's a game of chance and it just happens as it's just part of the game. And I'm probably one who can talk about this a bit, since I'm trading the markets now for nearly 20 years. And so I have some experience also facing losing streaks, and probably give you some insights. How do you feel, and also how to overcome these developments in your trading, which are common and natural. So let's have a look at today's agenda first, and then take it from there. So it's quite simple. There's things you have to keep in mind when facing a trading losing streak, which are, let's call it, common. Constructive criticism, adaptations in your trading, and mental stability. These are the key components of today's presentation. And before we start, first of all, I already said something about my person, trading about 20 years, probably a little more. No, not more. In fact, it's slightly less than 20 years, because if it was 20 years, I'd be older than I am. However, so my name is Jens. I'm located in Berlin, in Germany, trading the markets now for nearly 20 years, 15. Let's make it 15 years. And I learned to trade the markets, in fact, professionally and from scratch at the big stockbroker here in Berlin, after I finished my traineeship in a bank, studied mathematics. And yeah, so I went out on myself around 5 years ago. Before that, I was employed by a big broker and built their research and education arm, in fact. And then I finally decided to go out on myself, trade the markets, respectively, work as a consultant, respectively, market analyst for brokers. And here we are. So today I'm, and not just today, but also now for nearly 2.5 years, I'm here within this team around the Trading Spotlight webinar series, together with Paul and Marcus. And we are covering various topics around the markets and how to get started in your trading, respectively, what to take into account, and what to do, for example, when facing, let's call it, problems in your trading, respectively, how to stay calm, especially in today's topic or today's agenda. This will play an important role. The broker behind this Trading Spotlight webinar series is probably very important here. So in Germany, we refer to Admiral markets as the so-called DAX expert. And I already spoke in the introduction of this webinar about the reliability of a broker, which is important, especially under current market conditions with the elevated volatility. Having a partner who is really on your side, who you can trust, and where you know that there's a stable connection all the time, that markets are available. Sometimes the current market conditions as we face them, and some stocks especially, but this has also been the case last year around the let's call it Corona peak or a lockdown. A stable connection is very important because as someone who knows what he's doing, a trader, a profitable trader, professional trader, you need to have a broker you can rely on. You need to have a broker who provides you with enough, not just stability, but also liquidity in this case, in the markets you plan to trade, since sometimes these times here present the most profitable times of the year, and you just can't afford to miss them as a professional trader. And that's one thing which is very, very noteworthy when it comes to Admiral markets, because Admiral markets is really reliable. It's a broker who is in this industry now for nearly 20 years. And I highly recommend just checking out. I'm sorry, one second. I just recommend checking out Admiral Markets, admiralmarkets.com, for further information around the broker. Here in Germany, we refer to Admiral as the DAX expert with the most competitive offering when it comes to DAX trading. And so let's now dive into today's topic. And first of all, let's give a short introduction here around. Okay. So yeah, my main focus won't be the DAX today. In fact, but I can make it short. Let's put it that way. So the DAX is not very interesting right now with the current choppy action. At least not as long as we trade above 13,300 points. I could imagine, given the current increasing volatility we see, I could imagine that probably this is the it gives us some idea about what will happen after that, because usually you see an increase in volatility first, and then after that there's usually some kind of flush out, let's call it, or some kind of sharper drop, in fact. And then given the current developments we see in the markets, that's definitely something to take into account. What do I mean exactly by that? I mean, we at the beginning we refer to stocks which do not play, at least not at first glance, an important role in the market. So GME, Triple BY, for example, these are stocks which are usually not moving the markets, but given the high short interest from hedge funds, and there was a hedge fund on Monday, Melvin Capital, you probably have heard about this or read about it. Melvin Capital had to be bailed out with 2.75 billion, I think, from Citadel and from 0.72, I think. That's there's some connection with SAC Capital from Stephen Cohen. But the thing is that once you have trouble in a hedge fund mounting, and it's not just this one hedge fund, but there's plenty of hedge funds out there who have a high short interest in some stocks. And currently we see this pump in these stocks, which causes potential margin calls. And if these hedge funds have to liquidate their positions, and it's not just in these stocks, but let's say you have to meet margin calls and you have a position going, let's say in the DAX or in the S&P or in the Dow Jones or whatever, in gold and all this, it could be a wave of deleveraging, which is then the trigger for such a flush out. And if I currently look at the current tensions which are building and the current increase of volatility, I think it could be that there's some further downside to be expected also when it comes to the DAX. So especially if we drop below 13,300, I think it could be a quite quick drop then down to 13,000. But just a rough overview of the current situation. Today's topic is in fact more about the mental stability in your trading and how to cope with losing streaks. And so first of all, as I already said, the introduction. And here I want to recall one of our older webinars around Monte Carlo simulations. I haven't yet, right now, I don't have the link available, but in the YouTube channel, I highly recommend subscribing to the YouTube channel. If you now watch this recording on YouTube, just hit the subscribe button. Please leave a thumb up here. That would also be nice. If you have any comments, feel free to post them in the chat box below. And within this YouTube channel, you have a webinar, a recording on Monte Carlo simulations. And what we did during this webinar, and this is what we want to take as our fundament to make these ideas now I present to you a little more how can I say that, to fill them with some life. Let's say what we did there was we ran a simulation on a open range breakout strategy on the S&P 500, which I, by the way, post the setup and the parameters in the Traders Yard community every day. And the hit rate of this strategy back in this back test was from 2010, if I'm not mistaken, till 17, I think. So there was more than 5 years. That's definitely something I know. The hit rate was 47%. And we simulated here our strategy over 1,000 trades, given real trading examples. And so we use this to simulate different equity curves here. And what we've seen there within that was that there was a streak of 15 losing trades in a row. From a mathematical standpoint, that's quite common. If you have a hit rate of, say, a little less than 50%, that's in fact something you have to cope with, to have to deal with, and which from time to time happens. Based on my personal experience, I can say the longer I trade and the more I study the markets, and especially study also such statistical aspects of trading, the more the easier, let's call it, it becomes to cope with these developments and such losing streaks. Still, it's from a mental perspective, it's not very easy. So sometimes you feel really tensions and you start to feel frustrated. And so this is something you really have to not just understand, but also embrace. That's probably a difficult word in this context, but you have to make sure that you understand that this is just normal. It's just based on purely distributional, it's a pure distributional context, and it has no impact on the overall profitability of your trading. What you can manage here is not the losing streak itself, and if the next trade is a loser or not, but what you can definitely manage is the average losing trade in this case, and thus the risk you take per trade. So which means if you find yourself in such a losing streak, the natural reaction should be to reduce your position size. Don't stop trading. This is not what I'm saying, but because you do not know whether this streak will now last 15 trades or not, but keep on trading, but reduce the size once you drop a certain amount in your equity. Once you drop below, let's say, a moving average you have above your equity curve, for example. There are several techniques, but it's definitely important to keep on trading, since you do not know when things start to turn around. And in fact, it happened. I mean, I had streaks in my trading career when I lost something like 10 trades in a row. The loss was acceptable, but then it took me only one, sometimes two trades to turn the ship around and turn things positive. So that means that after, let's say, 12 trades, I was ahead thanks to the big gains I then realized. The only problem is if you stop trading here or switch to the demo mode, you do not have the chance to turn the ship around here and to end the losing streak. And so this is definitely something to keep in mind. That this is, by the way, now you might say, okay, but then you increased your position size. No, it's not. It's just a very favorable market environment. So I traded with a reduced position size, but the market went such a strong mood in my direction that I was capable to turn the ship around, even though I had already reduced the position size. And but come back to the introduction and this example here. So 15 losing trades in a row. And if you face such a losing streak, it's mathematically completely normal. Again, so from a mathematical standpoint, it's just part of the game and something you have to understand once you start trading. It's nevertheless still very, very difficult to stay rational during such a streak. And this is, in fact, what most of trading is about, in fact, to make sure that you understand that such streaks happen and then take the right steps without going bust, especially. So do not lose your account during such streaks, but also don't lose your mind and don't get crazy. But it's just something you have to understand, and where you then have to formulate a strategy, a plan, to stay mentally calm in this case, and just embrace it as part of your trading, respectively, as something which naturally happens and which you have to cope with. So in this context, now I have here our screenshot in this case, and those two charts. So one thing, this is important. Now you might wonder where I got these charts from. So this is a German website. I wrote a book. It's a German book, so it's not of high use, I think, for an English-speaking community. But what I did was I wondered, okay, if I read a book on trading, especially on a topic which is quite dry, how can I make sure that I really get the most out of it as a reader? And what do I like to see here in this context? And what came directly to my mind, straight to my mind, was, okay, why not set up a website where people can at least start to learn about the content which they just read something about? And in this context, I set up the website here with a Monte Carlo simulator, where you put in your, for example, initial starting capital. So this is German, obviously. The number of trades, then you have here your win rate, you have the number of simulations you want to run, and in this case, how many equity curves in this case you want to generate. And then you have the payoff ratio. So this is the ratio between the average winning trade to the average losing trade. And this, by the way, obviously is very important because you probably have heard about letting winning trades run, cutting losing trades short. So what does this mean? That means nothing more than the longer you let a winning trade run, the greater the average gain will be. And if you cut your losing trade short, it won't be an extensive loss, which means if you now calculate the ratio, the higher the payoff ratio, the lower the chance that you go bust with your trading, respectively, the higher the probability that you will be profitable in your trading. And that's why this is the old saying, let winning trades run, cut losing trades short. And this is here where this payoff ratio component comes from and why it's important. And then you see here the risk per trade. And what I then did was I ran the simulation, and the numbers I put in here, they come from real trading results. So I have real trading results. Now what I want to do is I want to make sure that I get a better understanding of what equity curve I can expect given those results, those real trading results, and what can I expect for the, let's say, upcoming 1,000 trades in this context. And there's several ways to generate such an equity curve given the winning, respectively losing trades. Okay, so and what we do here is we run such a Monte Carlo simulation, and in this context, you can here see the max winning trade series, respectively the max losing trade series, and there is 13 and 15 in this context. So this is something where you can now see there's obviously a high chance that you have a streak of 15 losing trades in a row, while the overall profitability is not affected by that. Because look here, this is 15 different equity curves given, or simulated equity curves, given the input parameters from real trades. And what you can see is all of them after 1,000 trades are ahead. So you won with every series which we created here. That's not a given, but this is definitely something to keep in mind, because this perfectly illustrates why you don't need to be scared to see a losing rate of 15 trades in a row, right? So you lose 15 times. Yes, it's exhausting. It's something which will probably cost you a night of sleep. Sometimes it shouldn't. If it does, it's most likely a sign that you're probably trading too big. But at the end, you can also see here that if you keep on trading that, and if you withstand any interventions and any increase of your risk, or just keep on trading the strategy like a robot if you want, and stay away from changing any parameters here, you will at the end come out ahead after 1,000 trades. So this is what we can get out of this, and this is something which directly results in this presentation effect. So the question we have is, what can we do to keep cool if we face such a losing streak? And as while there's no such thing as a blueprint, let's say, we have the chance to go through these 3 steps I just mentioned when looking at the agenda here. So first of all, constructive criticism. Then we have, by the way, this is wrong. I'm sorry, there's a C missing, but criticism, you know what I mean. Adaptations in your trading, and then you have the mental stability. These are the 3 key components we want to look here. So first of all, constructive criticism. What do I mean by that? Well, first of all, there's a simple question you can ask yourself, and this is something I highly recommend once you face such a losing streak. In fact, the question is very simple: do you follow your own set of your set of rules, respectively, your proven profitable trading strategy? If the answer to this question is yes, because you just follow the rules, like you programmed, let's say, an expert advisor, and the strategy I just made the topic here during this simulation is easily automated. So you can easily automate it and just let the EA run. In fact, then if this is the case, if you do nothing wrong here, then, well, don't blame yourself. Not every trade can be a winner, and losing streaks are mathematically completely fine. They are variance or bad luck. Sure, this is something that sounds very easy. Now you might say, okay, great, I have a strategy. I just keep on trading, because Jens said, keep on trading, because this is not a mistake. Well, the mistake potentially happens at another point. And this is something that's why I say there's no blueprint, and it's in fact quite rough. Because the thing is, now, just imagine you have such a breakout trading strategy. And in this case of the open range breakout system, we just made a topic in case of the S&P. So often, obviously, it's a breakout strategy. And now imagine you find yourself in a range bound market environment. You find yourself in a market environment with dropping volatility, for example. This is something where you just know that the strategy won't perform good. It's just a given, because for a breakout strategy to be profitable, respectively to perform well in the current market environment, you need a certain level of volatility. You also need markets, once they break out, to start to trend. The market really to see then an increase in volume, and especially, and market participants wanted to ride a wave, which then establishes itself. So what means nothing more than, even if you follow the rules, but you do not have a look at the, let's call it, big picture, or if you do not really understand in which environment you find yourself in, respectively, which bias is currently given in the market, respectively, which mode is given. And in this case, again, like a neutral environment / trading range, you see, and you want to trade also based on, for example, trend following strategy with the exit system based on trend following, well, you will naturally fail, because this is not just bad luck, but it's just bad trading, because the trading strategy you're currently trading does not correspond with the current market environment. This is very important to understand, because we here in this context, or once I prepared this presentation, this is something really I see as a given, let's say. In this context, I have a strategy which I know is proven profitable for the environment in which we currently trade in. So this is definitely something to keep in mind here. So we have a profitable trading strategy, and we have a market environment in which this strategy usually performs good. If one of the two is not given, first, you do not have a trading strategy which is proven profitable, so you don't know whether the strategy is profitable or not. Everything you make is in fact a mistake. That was a quote from K. Van K. Tharp, in this case, the trading psychologist. Or you have a profitable trading strategy which does not correspond with the current market environment. Well, then it's also a mistake, because the two are obviously not in line. So if both is given, if you have a profitable trading strategy and the market environment is positive for the strategy, and you face a losing trade, then you followed your rules, and there's no such thing as bad trading in this case, but it's just variance or bad luck. You just got stopped out, part of the game. And the thing you can still influence here in this context is the risk you take per trade. Now, the other thing is, didn't you follow your rules? Well, then obviously it's a mistake. You shouldn't look for excuses here. You made a mistake, which is fine because we all make mistakes. Let me just give you a perfect example from this week. So I have a clear given set of rules, in this case for my equity trading. Okay, so I have a clear checklist I go through every day, and on Monday, after the crazy developments we've already seen into the close last Friday in GME, I was looking at the stock. I was just like, that was fascinated from the volatility. That was something I was really fascinated from. So I looked at the stock, and I've also seen this tremendous rise. So just look at the chart from Monday. So this first parabolic move, and the stock topped that day, topped around 160 USD per share. So I was very, very patient. I was very disciplined. I was very focused on the price action, and I was just wondering, okay, how long can this parabolic move how long can we rise that in that parabolic fashion here? And when do we potentially top out? So I was quite sure that there will be kind of a blow off moment once the market just collapses. I mean, what we've seen the days after, that was something I hadn't on my mind or on my agenda. And this is something where I then stepped back from trading these stock, because that was just crazy. And I wasn't really feeling confident anymore, because I couldn't really see where all this will lead to. And probably we are in middle of the current meltdown of the financial system as we know it, probably because there will be several hedge funds going bust, and currently at least see much and lots of tensions right now. But come back to the trade. So what I did was I focused on the price action, and then I saw once the market touched the level around 140 USD, and it was already ahead, I think something like 100% already for the day. I saw kind of an exhaustion on the upside, and I took a short trade there, an anti-cyclical short trade. And then I had a quite tight stop. So that was something I wanted to keep in mind. And I was stopped out of the trade, and I just saw the market move, top out at 160, and then collapse from there. So the idea to see a collapse, that was perfectly right. The only problem was I was a little too early, and then I saw. So I paid instead of profiting from the current price action. So that was kind of frustrating, because first of all, there was no real, let's call it, playbook for the trade. So it was like, I have a set of strategies here, but that was more like a gut feeling. That was more like a massive extension on the upside, which I wanted to profit on than on the downside. And the thing was, now, how can I criticize myself in a constructive way to learn something out of the trade? Not just tell myself, you're an idiot, you just bet on a massive rise in the stock, that the stock will drop, and in an anti-cyclical fashion and all this. But it was more like I wanted to learn something out of it so that I can profit from it. And I did, in fact, given then what trades I did following the day, Monday in this case, so over the last days. And what I right at the start, when I reviewed my trade, saw was that I was just too big. I mean, the trade was completely fine. So you can I could, for example, say, well, there was an extension from VWAP. Okay, so volume weighted average price. I look at here, and if I see a VWAP or an extension from VWAP, something like 7 ATR or something, 6-7 ATR, that's just too much. This is what you could easily refer to as we are extended on the upside. So from that perspective, it's completely fine to then take a trade there and bet that there will be a sharp bounce. I think this is completely fine. The problem resulted more out of the fact that the position for such an experiment was just too big. I was trading way too big. So that doesn't mean that I was extensively a short here and bet a huge amount on a drop in the stock, and now I saw a massive loss. That's not the case. So I have a daily stop loss level, for example. I set an amount I'm willing to lose for the day. And then based on that, I take a portion of it per trade I'm willing to take, and then I take the trade. So if I now take such a trade, given my daily stop level, and I'm risking, let's say, 2/3 of my daily stop, it's just too much. This is just too much. Doesn't make sense. It's too big. I'm still within my risk parameters, which is completely fine. So I'm not dying because of the losing trade. But the thing is, it was too big given my knowledge of the strategy. I had no real, it was more like a gut feeling. I mean, I could technically explain what I was planning to do trading a pullback towards VWAP in this case, the risk reward was definitely favorable, as we've seen then several minutes later with the collapse. So we are talking about, in fact, a window of something like 3 minutes or so after the market topped out and dropped then for something like 100 USD from 160 down to 60 USD per share. But the thing is that I want to learn something out of it, constructive criticism in this case. And so I didn't look for excuses here. I took full responsibility for the trade I did, but I wanted to learn something from it. I realized the mistake, which was I traded too big, and I took, based on this, the knowledge that I was still within my comfort zone for the upcoming days especially, and wanted to make it better and look for, I focused on the process. It was not just the result. I mean, at the end, okay, it's a small loss, which is completely fine, but within what I'm willing to lose per day. But what I want to see then in the upcoming days, not getting frustrated, but instead see a chance to grow out of the mistake. And this is what I refer to as constructive criticism. And so what was the solution in this case? Very simple, take down the risk. So in fact, even though I didn't trade GME anymore over the last days then, the next day I still had a trading setup for the stock. And what I plan to do is I was willing to take the trade. It was also given a setup given within my playbook in this case, which is great. But the thing is that I then, right from the start, decided to massively reduce my risk and say, okay, this is not a, let's call it A plus setup here, but it's more like a B setup. And if I'm in a B setup, I want to reduce my risk to a level which is fine for me that day. And this meant nothing more than I took down the risk from 2/3 the day before down to 20%, probably 25% of my daily stop level. The trade was not filled, but that was the solution I took here and I grew from. So it was the experience and the solution I formulated, given my trade review here, which gave me a chance to grow out of the trade and feel confident again. And really, I really look forward to the next trade. Looked forward to the next trade I took. And this is something what I mean if I talk about constructive criticism in this case. And as you can see here, I don't want to make this mistake again. So based on the solution I formulated, I think this is something definitely which is achievable. And then I move on and wait for the next trade, for the next setup to present. And so here, now let's come to the next thing. So the next point, adaptations in your trading you have to take. We already made this a topic, in fact, given what I said, breakout strategies, trading, let's say in a trading range, for example, or trading range approach strategy, you then trade in the trending market, for example. So therefore, it's obviously necessary that you know what strategy you trade. And then the next question, the follow-up question here is, did the market conditions change? So as I already pointed out, obviously, this is important to know because you have to know which strategies you trade and which market environment is favorable for you. So this is important to understand that not all trading systems here perform equally well under all trading conditions. I think this is mostly self-explaining, so we can quite quickly go through this here. And still, I want to motivate you. If you face such a losing streak, let's say 5 trades in a row, 10 trades in a row, that is the number, depends a little on your frequency you take trades. So if you take, let's say 100 trades, probably it doesn't make sense to say I look at after 5 trades whether the market conditions have changed, because 5 trades is usually what you do in the first hour of trading, let's say. But I just want you to motivate you to, given your trading strategy and your frequency, your trading frequency, to keep this in mind, take a step back, and then change the parameters, if possible, of the trading system. Respectively, parameters of the trading system, that's probably a little too much, especially if you're let's say quite active trader. Change your parameters, let's say every day or something. That doesn't make sense. But reduce the position size. So this is something I'd recommend in this context. If you do not feel comfortable with the market anymore, there will be plenty of opportunities available the next day. Believe me, the market will open. You will have a chance to trade the long side, the short side. There's no real problem with that. If you do not feel comfortable, take a step back, breathe in, breathe out, reduce the position size, try to regain control, rebuild confidence, and then take it from there. Steadily build yourself up back in your comfort zone again. And if the market presents itself, therefore, again, you need to know your strategy, presents itself in a very favorable way for you. Increase the position size, get out of your comfort zone and get bigger in the setup. In this case, you're trading because you know it works and it will pay handsomely in the long run. Then that brings us to the third part. So mental stability. It's a quite esoteric question, probably. The question, who are you? It's a very important question, in fact, because many people underestimate the dependency also on, for example, the products they trade, the emotional state in which they find themselves every day. So it's very, again, this is something we can also make a topic in another webinar if you're interested. If I hear someone saying, you're not allowed to be emotional in your trading. I know what someone wants to say with that, the coach wants to say with that, but it's something which is completely unrealistic because we are not robots, we are human beings, and human beings are emotional. So it doesn't make sense to say, hey, I try to avoid any emotional states in my trading. That's completely natural, completely normal. But what you should aim on is, in fact, to make more of what you get in a, let's call it, emotional positive state, and do less from which gives you emotional or which puts you in an emotional state which is negative, especially when it comes to your trading performance. And to know that, it all comes down to the question, who are you? So if you know yourself that, for example, you're impatient and that you have kind of a, let's call it, attitude to become emotionally involved, and you're someone who's probably taking, not too much risk, but if you have a trade going which has an inadequate position size, for example, it's a high leverage product, for example, a high leverage position, and you just do not feel comfortable because you now tend to take your potential gains quickly, while you start to hope that the market will turn around once the position moves against you, and there's a wave of losses probably, which will result of this. This is something which is very important to know because it gives you already an idea of which products you should trade, but also it gives you an idea of how much risk you should take in your trading. So, for example, if you start your trading career and you say, well, I have a 10,000 USD account, for example, and I don't feel comfortable risking more than 50 USD per day, well, that means nothing more than your daily stop is, in this case, 50 USD. And you should stick to that. And there's certain ways you can then work with. For example, give yourself an alert which goes off once you reach this loss level for the day, for example. But this is something which all comes down to the question, who am I, and what do I feel comfortable with? And so that brings us to this point. So if you become emotional in your trading, usually becoming emotional in your trading, having feeling of getting scared once you open a position, or a feeling which is like resulting in kind of a gut-wrenching feeling or something like that, this is usually a sign that you're too big. That's usually a sign that you're too big, which is very interesting. Let me just come back to the trade I just illustrated to you. So from Monday, in this case. So, I mean, I'm in this trading business now for nearly 20 years, as I said already in the introduction. And I know myself really well. What works for me, what doesn't work for me. And you know what was very interesting? When I took the trade, there was, right in this moment, when I took the trade, I managed to trade as a professional, as I usually do. So I'm a professional trader. So, but there was still a sign which was sent from my body right in this moment. And there was a short moment of gut-wrenching feeling. So we're not talking about huge amounts of money or something like that. But in this moment, my body realized, and my subconsciousness realized, there's something going wrong here. This is not right. It wasn't that I didn't feel comfortable taking the trade, even though it probably is not in my playbook. So it's not about that what I planned does not work or something. I think the longer or the more often I take such a trade, I will at least break even on these trades, given the very, very attractive risk reward. But what was very interesting was that the gut wrenching feeling resulted of the fact that my body, even though it was subconscious, obviously realized it was trading too big. Again, I was within my risk parameter, so it was not too big in a like over leveraged way. That's not true, but too big compared to the daily stop level I set for myself, and I have in myself subconsciously then, and I live with, and I know that again. Okay, so my body knows that once I break this position sizing for such an experiment, my body reacts in a very, very straight way. And in this context, I had such a short gut wrenching feeling. So this is also something, if you, and this is again, you have to know yourself, you have to observe yourself, and this is something which makes trading obviously a very, very interesting and intensive endeavor in this case. So a very interesting journey, and why I'm so fascinated, because it teaches you a lot about yourself. And if you see yourself behaving in a certain way or feeling a certain way when you make a mistake, this is a clear sign you have to change something. Gut-wrenching feeling in this case means I'm risking too much on the position. It's just not justified to take the risk I take here. And this is the thing now. The thing is, you have to reduce your risk to regain confidence then. And this is exactly what I did. So it was just one trade, but it was a clear feedback I received there. And I just stepped back and was like, okay, what happened? What went wrong? I took this. I mean, again, this is not a losing streak in one losing trade. So that probably might be a little escalating right now, let's call it. But I just want to give you a real life example so that you can really gain something out of this presentation here. And so again, this is something you will face over and over again in your trading, and you have to observe you have to observe yourself very, very clearly and intensively here to make sure that you take the feedback from your body, respectively, from your mind, your thoughts, really into context here, and to get to this point of mental stability. And again, it's important to know yourself well. It becomes clear why self-confidence is such an important aspect among professional, profitable traders. So self-confidence in this case doesn't mean you're arrogant. So this can happen if you get overconfident, but self-confidence is like you know yourself and you're confident in yourself, given the fact that you know yourself, you know what your strengths are, you know what your weaknesses are, and work with that, and take this then, or take your trading from there. And so the final point here, mental stability, is also something, it's really unbelievably important to have something completely different than trading. Working out, go to the gym. Right now, difficult, COVID-19 pandemic, lockdown, stay at home, blah, blah. The same is true, meet with friends, relax with your family. There must be something which allows you to get your mind completely off your trading. So this is what I'm talking about. Let's come back to Monday. That was the first reaction. That was this gut-wrenching feeling. That was like kind of frustrating, especially after seeing the price action shortly after, confirming what I just expected to happen, at least short term. So then from there, we went parabolic again. But when I took my notes in my trading journal and took learned something out of this, before that, I worked out. So I shut down the laptop then, cleared my mind, went for a run through the park. I had a short, quick workout, talked to my family, talked to my wife in this case, had a chat with my two kids. And after my kids went to bed, and my wife was, I think, sitting in front of the TV or something like that, I was just going back into the office, sitting down, opening the laptop again, thinking again through the trade, and draw the right conclusions, but with a clear mind in this case. And this is very important to get the distance between your trading here in this case and then drawing the right conclusions out of this. So again, that's just one trade, but it's a real life example in this case, and something I highly recommend you doing too. So also, this is something which is not the same for everyone. So some people need to work out, go for a walk through the park, or I don't know, talk to the wife, or have nice dinner. But get something, look for something which gets you completely, your mind completely off from trading, so that you have really a clean state once you draw your conclusions out of what you just witnessed and what just happened during your trading day. And this is especially true after a string, a series of losing trades. And yeah, so I just, yeah, this is like the state of, and we call this being in the zone. Like you talk, and then just look at the time, and then just realize that it's already time to come to an end. So that's a very good sign. I hope you profited in some way or the other here from what I just said. 1 second, by the way. Oh, thank you very much. Thank you very much, Anna. She just shared the link to the Monte Carlo simulation trading spotlight webinar. So we also will have this in the description box for those who are here now watching this on YouTube. Then we you can check the description box for the link to the Monte Carlo simulation. And yeah, so that's on that. If I have a hot stock available, that's a good question. So right now is the U.S. market opening. I'm currently watching Plug, the company Plug Power in this case. Had a very strong run over the last weeks, and I'm also, besides the developments in SLV here in this case, so the silver ETF in general, silver and also gold are very interesting topics right now due to the potential drive here. But yeah, Plug, let me just see. I mean, I haven't checked it right now, but if we break below 63, I think there could be some downside down to 60 and probably even lower than that. But I haven't checked the chart yet, so I hope that still that this answers the question. So yeah, let's go through the summary here in this context. So first of all, losing streaks in trading are completely normal. They happen because they're part of the game. But this is the thing, it's only normal, and you can draw conclusions out of that and decide whether it was a mistake what you just faced, losing streak or losing trade, if you followed your rules. And this is only true, obviously, if you know what to expect from your trading strategy, but also from yourself, from a mental perspective. And that means that then staying cool, rational, and maneuvering your trading account without prejudice to significant losses becomes possible. Only then it becomes possible. So you have to know what you're doing, you have to know yourself, and take it from there. So this is the first step, in fact, before you start your journey as a trader. And there's 3 effective steps you could go through. So first is constructive criticism. So which means, did you follow your rules? Yes, no. If I did, and strategy corresponds with the current market environment, obviously it just happens, bad luck. If you have a strategy which corresponds with the market, but you didn't follow the rules and have a losing trade, well, address it and find out what happened and take it from there. Then you should take adaptations in your trading. So does your trading strategy and the current market conditions, for example, currently correspond well with each other? If so, well, it's a natural losing streak. If not, you have to adapt. For example, trade a strategy which corresponds well with the current market environment. And finally, mental stability. So do you currently perform out of your zone? So are you, for example, is there something happening in your life which you probably can't control? It's just happening because there's some let's call it some argument you had with your girlfriend. It sounds ridiculous, but there are people, I met people during my trading career which are going through the roof based on that, because it builds. So it's like you have the argument with your girlfriend, the argument with your boyfriend, and then there's something else happening, like you lose the internet connection, for example, or there's short-term a problem, I don't know, whatever. So there's someone ringing on the door, and you just explode emotionally for whatever reason. And this can naturally that can be a reinforcing process in a negative way in this case, and cost you lots of performance / can also cause heavy losses. And I think that's not just one day, but there's sometimes periods where it takes weeks. Okay, so you have to calm down. You have to know, again, you have to know yourself, and you have to formulate strategies and ideas and solutions which help you to overcome such developments during your life, naturally affecting your trading in this way. So, oh, by the way, that's right. So don't forget to join us next time. So Paul will be here on Monday talking about the US presidential inauguration and answering the question, what's next? So that includes that he will answer the question, what happens now? What does it mean? So the next president was inaugurated on the 21st, Joe Biden, 46th president of the United States. What does this mean, especially when it comes to gold, when it comes to US dollar, when it comes to equities? Are there any seasonal patterns happening? It will thus answer the question how this potentially affects the market, and then how do we turn that into opportunity? And Paul is the one to listen to here in this context. 2 p.m. London, 1st of February, so Monday. And if you're here now in the event itself, in the live event, we can ask you questions, then check the inbox for your webinar, for the webinar link. If you watch this on YouTube, again, please leave a thumb up here. If you have any comments, feel free to use the chat box, subscribe to the YouTube channel, head over to the Traders Yard Spotlight community. If you want, you can also register for the live event taking place on every Monday, and in this case, then Friday. So from February onwards, by the way, we will focus on Monday and Friday, Wednesday, not Monday, Wednesday and Fridays. So this is just for information purposes. Admiralmarkets.com, head over there, education, there you have a tab for webinars, and there you can register for the Trading Spotlight webinar series. Again, then after you registered, you get an invitation link for every webinar. And here are the contact details from Admiral Markets for further informations. Feel free to reach out to Admiral directly with all your questions. Also, here, the risk disclaimer, highly regulated financial service provider, Admiral Markets. So that's something we have to show at the end. And that's it from mine. So all the best. Happy trading. Watch your stops. Talk to you again next week. I look forward to it. See you.